All right, tonight we are doing a review of 5 tech stocks for 2026 that aren't NVIDIA according to Marketbeat. I'm Hugh from Wall Street X. A reminder that most funds cannot beat the S&P 500 and to always do your own research. But starting off their list at number 5, they have Analog Devices Inc. or ADI stock. The one-year return has been 32.8% and the average analyst rating for this has been a buy, even though the average one-year forecast is negative 0.4%. The PE is pretty high at 62, but the earnings growth is really, really good at 14. We put this one as a sell, and our target price is 0.7% lower this time next year over today. And some pros for ADI: they have strong profitability and margins and a pretty diversified business model. They do B2B, which is a great source of revenue, very stable. Cons, though: premium valuation, 60 PE is pretty high. Definitely not the highest on this list, but they have the earnings growth to match that and balance that out. Capital spending and cost concerns, that's just kind of the technology right now. You put all your money into it, you wait for the return, and then you slowly start to squeeze revenue out of it. Competition and geopolitical risks, again, that's going to kind of apply to all the stocks in this list because they're all AI, and there's a lot of movement in that space right now. So for that reason, we have the risk as high and the return as medium. We put ADI as a sell right now, but it could be closer to a hold if you're in it right now. Number 4 on the list is Marvell Technology Inc., MRVL. We've done lots of coverage on this. Their one-year return has been negative 20.5%, and the average analyst rating is a buy, but their one-year target forecast is 27.4%, very high. The PE is pretty good at 31, especially when you consider that earnings growth is forecasted to be 19.9% year over year for their EPS growth. Very, very strong numbers. Even if that's only semi-accurate, even if you can get somewhere close to that, you are very, very solid ground. So strong buy for us. Our target price is 15.1%, and our algorithm is very, very conservative, so we usually come in lower than analysts on there, but still, we're a strong buy. Pros of Marvel stock: strong partnerships, Amazon, Microsoft, Google, the rest of them, high growth potential that comes along with those massive, massive contracts, especially in the hot AI space right now, and an attractive valuation. Like I said, great PEG ratio, PE to growth ratio, very, very nice there. Cons, though: intense competition. Competition's heating up. Stock volatility, this one's been particularly volatile recently. And customer insourcing, this one, it remains a risk that a lot of their major contracts like Google, Microsoft, they can develop in-house capabilities, and they might not need this company eventually in the future if they do their own spending in this tech. But that's a pretty broad risk that applies to a lot of these companies right now. So the risk is high. The return, though, is high, and we put this one as a strong buy because we think the return very slightly outweighs the risk for this one. Micron Technology is number 3 MAU stock. The one-year return has been 146.2%. The average analyst rating is still a strong buy, even though they forecast it to decline at 10.5% over the next year. Super small dividend at 0.19. We have rated this one a buy, and our target price, interestingly, is actually higher than the average estimate at 10.9% right now for the one-year return. Forecasts for pros: great valuation, PE of 34 with a 17% forecasted EPS growth, very nice numbers. Strong revenue and earnings growth, of course. Some cons, though, potentially, just like the other ones, competition strong, but high capex right now for sure, especially if they're going to compete with Samsung. High risk, high reward, buy for us. Number 2 is Broadcom, AVGO, AVGO stock. The one-year return for Broadcom has also been very good at 104.2%. The average analyst rating is a strong buy, and the average one-year forecast is 6.7%. Very high PE, almost 195. Very high earnings growth, though, 35%. Pretty much balances out. Advantages: strong revenue and net income growth, significant backlog and orders, which is what you want to see, especially right now. Very consistent dividend as well, which a lot of people might not know about. It's not very high, 0.64%, but it's there and it's consistent, and that's got to count for something. Disadvantages, high valuation, even given high growth forecasts, and it's been pretty volatile lately as well. So we actually put the risk as lower on this one. We put it as medium. The return is also medium to match. We put this one as a buy for Broadcom. And the number one stock on their list is Advanced Micro Devices, AMD. It's kind of like a mini NVIDIA. AMD's one-year return has been 66.9%, and the average analyst rating is a buy. The average analyst one-year forecast is 12%, PE of 109, which is very high. But you know what else is very high? Their EPS growth forecasts at 62.5%. Absolutely absurd. No dividend, but we've put this one as a strong buy. The one-year price target for this, we put it at 31.8%. So we think it's going to go up 31.8% is our forecast over the next year. That's one of the largest forecasts we have. The pros of AMD, strong revenue growth forecasts. They are a viable alternative to NVIDIA, although they're slightly behind NVIDIA, but they're a smaller company. Lots more room to grow if you look at it that way, which is great. Strong fundamentals with AMD as well. Debt to equity is fantastic. Cons of AMD though, intense competition from NVIDIA is obviously putting up a fight, holding on to their moat and their market share. But AMD's ROCM is good. It still has some catching up to do in terms of maturity and optimization though. And this one, premium valuation, but it's got the growth to back that up. So that's going to make this a high risk, high reward opportunity. And we put AMD as a strong buy. So we certainly agree with that one. And that is our review of the 5 tech stocks to buy for 2026 that are not NVIDIA, according to Marketbeat. You can go check out the original video in the description below, or visit wallstreetexec.com for more content and ratings. Otherwise, have a great night and thanks for watching.